Okay, now in the interest of full disclosure, by the way, Scott and I have known each other for a while, and if you'd like the full true story of what Millennium Trust does, you can go to my website, terrysavage.com, and look back to, we figured out it was in March, when I wrote a column featuring Millennium Trust as one of the great national companies. There are others across the country that act as custodians for IRAs for non-traditional assets. So we talked then, and we haven't seen each other till today, and you're going to be pleased with some of the things I recommend today. So let me get started. Mayors, trustees, business people, all of you, and also the lawyers, and thank you for the bankers to be here. We know you're the ones with all the money. I'm going to prove that in a minute. I am delighted to be here. Oh, I want to not forget this. That is not my latest book as of this week. Now, so this is a shameless plug, and this is also something totally different than anything you've ever heard from me, unless you are one of my very close personal friends. Here's the new book out this week. It's called The New Love Deal: Everything You Must Know Before Marrying, Moving In, or Moving On. And I've never had more fun with the book, and I wrote it with two fabulous women co-authors, Gemma Allen, a famed divorce attorney in Chicago, and Judge Michelle Lawrence, who for 20 years sat on the family court, divorce court in Chicago, and is now a mediator. And we have written thing you wished you had known before, could still apply to your relationship now, even if you're already married, but for whether you are just moving in. How about whether you have 17 and 18 and 19 and 22-year-olds who you want to impress early? We talk about cohabitation agreements, moving in, prenup, a whole lot about same-sex marriage, and it's constantly evolving. So The New Love Deal is available on Amazon.com. You can look under Terry Savage on Amazon, or at terrysavage.com, or at thenewlovedeal.com. This is fun reading. I mean, it is, can we talk? Yes, we decided we were all women of a certain stage, and we knew stuff. We talked. So you'll like this book. Give this as a graduation present. Okay. All right. Okay, I want to do something today. I want to talk about, you know, it's enough, and it's a gloomy day. I am not talking about the clouds today. I'm talking about the silver linings. You know, 7, 8 years ago, when we were all extraordinarily depressed and it looked like America was falling off a cliff, I was the one sitting there on TV saying, no, this is not the end of the world. And I always start with that same slide. Don't bet against America. America will survive and prosper, and so will you if you plan, save, and invest. Now, it was tough to preach that over the last 7 or 8 years when people were dumping their stocks in March of 2009 at Dow 6,700. Now, today, we're almost at Dow 17,000. This is not an I told you so. This is a reflection of the long-term overall strength of America. So today, I want to show you the silver linings, and I'll give you a peek at the clouds. It's kind of the reverse way we've been used to looking at the economy and the economic outlook for the last few years. And I'll just say that I think it's time to be a bit more optimistic, but also be realistic. So, be happy, at least for a while. Thank you for all. I mean, what more do you need to know? Stocks are soaring. Interest rates are very low. Jobs have been coming along. We have low inflation, and the economy is growing. Be happy. Smile. Everybody smile. I know our problems aren't over, but the fact is that at this particular moment, and as I see it, and I'll give you a bit of a forecast and just a little bit of personal finance advice, this is a moment where you can exhale for just a little bit, and you can take advantage of the opportunities that others are too scared to take advantage of. You're wondering, did you hire Pollyanna? No. America has problems. I'll have to mention those, of course. Here's the biggest one. This is from truthinaccounting.org. It's a two ticking time clocks, actually, that is online, and it's a website put up by some people out in the Chicago suburbs. It shows our national debt, our official national debt of $17 trillion, the unofficial national debt, the promises we've paid in the future for retirement benefits for government employees and military and Social Security and Medicare. That's overwhelming. They call those MIGO numbers. My eyes glaze over. $76 trillion. How will we ever pay that off? The answer is there's only one way. that's acceptable, and that's through economic growth. Look, if we're going to look at the silver lining, not the cloud, let's take a look at federal budget deficit. This is just over the last decade or two, and you've seen, of course, those huge years of budget deficits in the $1 trillion range. Here's the good news. CBO just announced that our estimated budget deficit for this year, fiscal 2014, will be only $492 billion. See, things are getting better. And do we worry about that? How are we going to borrow the money? I mean, my goodness gracious, who's going to keep lending to us? Oh, well, thank you, China. They've been lending us money. In fact, the red bars on this chart, and this goes back to 1952, the red bars are the increasing percentage of foreign ownership of our debt. They've been willing to hold American dollars, even at today's very low interest rates, and lend us money. I don't think they're just being generous. They have their own reasons, which I'll come to in a moment. And it's not just China. There's Japan. Each of them owns over $1 trillion of our national debt, and they seem to be willing to keep buying. And if we run out of people to buy our national debt overseas, I know you'll be gratified to know that in addition to them, the Social Security trust funds also own $2 trillion of special purpose IOUs, special purpose treasury bonds, so that your shoebox, anybody still remember the concept of a shoebox in Baltimore? Your shoebox that's holding your Social Security account, when you open it up, it's filled with IOUs from the federal government. So we really don't have to worry about our debt. This is what I'm talking about. You know, some people see a cloud for every silver lining. Today, we should focus on the silver lining for a change. But I will show you some of the clouds. We want to be happy. It's not just an accident that Pharrell's got a hit song about that now. America's ready to be happy. I want to show you a headline I cut and pasted from CNN Money. And it says, job market returns to 2008 peak. This is from June 6th, just a few days ago, when the unemployment numbers or the employment numbers came out for last month. It says it takes 2 years to lose 8.7 million jobs and 4 years to gain them back. We're back. What cloud? Now, some of you want to have a little bit bigger perspective, so let me show you. If we put that in perspective, this is long-term unemployment chart. It goes back to 1950, and our current 6.3% actually looks pretty high when you think about it for an economic recovery, but we're coming along. Why did the unemployment rate drop so precipitously when I bet most of you haven't been the ones doing the hiring? Yeah, we've gotten back to those old jobs. We're down to 6.3%, but I'll give you another chart if you really, I'm giving you the savage truth here, the perspective. Take a look at this chart. That is the participation rate of the civilian labor force. And you can see that it peaked in center in 2000, and it has dropped precipitously in the last 5, 6, 7 years since the recession. In other words, people are no longer, they've dropped out. They are no longer being counted in those seeking for work. And if in fact, if they were, then our unemployment rate would be more like 10+%. So that's part of the reason you get these rosy job numbers, not to say that it isn't getting better. Let's take a look at economic growth. Now here's the Conference Board's latest consensus from all the economists they survey, so I'm not just picking optimists or pessimists. And the consensus is that the GDP will, by the end of the year, average out to a growth of 2.3%, and the forecast for 2015 is slightly better at 2.8%. So that's why you are feeling, and I asked each and every one of you I met, yeah, it's picking up cautiously, right? Let's put that one in perspective. That's the silver lining. Here's the cloud. Okay, that was January. It was cold. We just had it revised to -1%. But let's take a longer perspective on GDP. And this one is from 1980 to the present. And let me just point out that we had a horrendous recession, some of you who remember it, 80 and 82. And when GDP bounced back, it was up growing at 10%. How does that compare to maybe we'll get to 3% this year or next year? in this economy. This is why every time you see the silver lining, you have this little nagging cloud feeling. But consumers are feeling better. There's no doubt about it. There's a consumer confidence, and this is from the last few years, and it's rebounded to 83 from a low of 22 in March of 2009. So see that nice uptrend? I want to put it in a little longer term perspective, however, and there you have it from 1967 to the present, and we are way below the 2000 high of 140. So clouds and silver linings. Yes, things are a lot better in the economy than they were at the bottom when there was doom and gloom, when the economy was really declining. We had negative GDP, but still not back to where we should be. However, let's just focus on the good economic news, because it is real. And you know it. If you let yourself feel it, if you let yourself feel that silver lining, you know the economy is heating up. And we're having better news on small business creation, on jobs, on consumer confidence, on consumers' willingness to spend and take on debt and buy cars, and even to buy houses. We are not at the blistering pace of the previous decade, but things are picking up again. And this is the perfect time for all of you in business to take advantage of that. It's always easy to get stuck in the last crisis and not recognize that the tide is moving again. Look, the economy must be booming, or at least picking up. Why else would you have the stock market at an all-time high? What's going on? Well, I think the issue is money, pure and simple. Follow the money. And where do we have to look to follow the money? For starters, we have to look to our own Federal Reserve and Janet Yellen. And the Fed has said, this is their stated policy, although I know they parse the words every week, that yes, they are taking back some of the money they put. This is a taper, and it is going to continue. But they're keeping interest rates low. That's their target. They're not only are they buying less, but the government is borrowing less. You saw the deficit coming down. Okay? Foreigners continue to buy our debt willingly, and the banks have been building reserves of cash because they have new higher capital requirements. So that's where all the money is going, and the Fed says it's going to keep leaving the money there. Now, I want to time out here for a minute and indulge me. I know this is a sophisticated audience, but a few years back when this started, I made a series of 3 graphics to try to explain to the world something you already know, which is how the Federal Reserve works. This vastly oversimplifies it, and I'll get back on track in just a moment. But A, I like the graphics, and B, they set the pace for what's really going on in the economy. So this is my story of how the Federal Reserve works. I always say, think about the economy as a giant bathtub with the water pouring in, with the hot and the cold spigot, and flowing out the drain, just as if you were giving your little kid a bath. And your job as the Fed is like the mommy, to keep the water at just the precise water level and just the precise temperature, the mix of hot and cold. And when we had that horrible recession in 2009, oh my goodness, things started flowing down the drain. The Fed's job was to start pouring money in to keep the economy going. And that's what they did. Oh, we had all kinds of programs. We had TARP, remember Cash for Clunkers, QE1, QE2. I mean, they really added $4 trillion more or less to the economy. But at the same time, we had all these things going on. We had money flowing out, bankruptcies, write-offs, bad loans, and so forth. It was just one thing after another, and now we have the taper. And the Fed's job, which it's doing all right now, is to keep the water temperature just right, at the right level, and keep the economy moving along. So I always love that analogy, but I decided I had to get more modern. So I took a more modern bathtub, okay? And you've all had a jacuzzi bathtub, and everyone who's had one has had this experience. You get the water level just right, the temperature just right, and then someone turns on the jacuzzi. And then what happens? It spills over. Well, the jacuzzi is something called velocity. It's a big economic term, but it says what happens if the water isn't just sitting there. It starts moving around and it sloshes out. Now, one more slide from my Money 101 speech, okay? Because this will apply. Does anybody still play Monopoly with your children? Is that a game that you play? In my family, we played Monopoly all the time, and no, I was not the winner. My young brother was the winner, and he was also the banker. Now, you remember when you pass out money in Monopoly, everybody got 2 gold $500 bills and a bunch of green 20s and da-da-da. Okay, so I, being a very conservative Monopoly player, that's how I invest as well, would always take one of my $500 bills and slide it under the board, so I would have it in case I was fortunate enough to land on Boardwalk or Park Place, the 2 best properties on the board. Now, we would be playing the game, and it would be going slowly. Nobody was buying anything. Nothing was happening. My younger brother, the banker, who's still a maniac today, but a very successful guy, would say, you know, we got to get this game going. And he would decide to hand out more money. And he would give money to everybody that got a couple more $500 bills, okay? Now, what happens when you land on Boardwalk in real life when the bankers put more money in the game? It's still the same property, the best on the board, and I still had my $500 saved so I could buy it. It cost $360. But now the rules of the game are if anybody lands on Boardwalk, everybody can bid for it. And everybody has more money. So the price goes up to $500, $1,000. Someone says, I'll take my 2 new $500 bills, I'll bid $2,000 for it. The price goes up, the property stays the same, but the price goes up, and the value of that $500 I saved, the buying power goes down. That is my 101 definition of inflation. And there are younger people here who haven't really lived through inflation, and I thought I'd bring it up because I'm going back to real life now. This is the money supply, the monetary base. This is from Federal Reserve Bank of St. Louis, and that is what has happened to the monetary base just since 2008. This chart goes way back to, I think it's the early 90s. That is what the Fed has done. They've put a ton of money, trillions of dollars into the economy by buying up not only Treasury IOUs, which they used to do, but mortgage-backed securities, which are about 16% of their portfolio. They were the buyer of last resort. They paid for it with newly created money that they paid to the sellers of these things, and the money got into the economy. So why haven't we had that price inflation yet? Here's why. Remember the jacuzzi? Velocity. There's another Federal Reserve Bank of St. Louis chart. I'm mixing up, you can get this, you know, true economics with true Terry Savage. The velocity has gone down to practically zero. The money is just sitting there. How many in here are bankers? There's money in your banks, right? But bankers are justifiably concerned about lending it. They have concerns about their old bill loans. They don't know how good the economy is going to be. There's all kinds of rules and regulations on everything coming out of Washington. They're being asked to hold more reserves. The bankers aren't lending it. The businesses, those are you, aren't buying it. Is there a lot of expansion going on? You're just glad business is coming back, but it's going to be a while before you break through the shopping center storefront and take the vacant store next to you, right? And buy new fixtures and believe that the consumer is going to spend. And the consumer is going, oh my God, my house might not be underwater pretty soon, but I'm not sure about my job. So as a result, everybody's sitting on the money, and that's what's happening to the economy. And the only place the money is going has been, up until now anyway, into the stock market. That's the story. So, despite all of this, our currency, the US dollar, oh, there it goes, the stock market. Our currency, the US dollar, is the strongest currency in the world. Strong means, for the muscle man, is people still want to put money in dollars. Money's coming from all over the world to go in dollars, maybe not to get very low interest rates, but to buy stocks. What makes the US dollar so attractive? We have low interest rates. How can it be so attractive? We still have those huge budget deficits. We have tons of political turmoil, more about that in a moment, and we've made a mess of our foreign policy and whatever politics you think. Why is money coming to America? Because we are the least worst place for the world to put its money. Okay, and this is really important because it's all those long-term clouds that I talked about. We're still, in the reality of today, the least worst place. Let me show you what the alternatives are. Take a look at the Japanese yen. If you follow global economics at all, you know that the Bank of Japan has announced, and the government is in favor of the fact that they're going to print a lot more money because they've been in deflation and almost depression, but surely slow economic growth for years. Their population is aging. They are trying to devalue their currency by creating more of it so that their exports look cheaper. If you have a cheap yen against the dollar, a dollar can buy more Japanese Toyotas or whatever, or TVs or whatever they still make in Japan. And how do they do that, by the way? Oh, they buy dollars and sell their currency. So that's why they're buying our OUs. The same thing has just been announced in the last month or so in Euroland. They've had enough of austerity. They stared it in its face. And Mario Draghi, the head of the European Central Bank, has said, we are going to devalue the euro and stimulate economic and export growth for countries like Spain and Portugal. We have all these tools. We're going to do whatever it takes. I mean, that is the out-and-out stated policy of the Euro Central Bank. And then the Chinese, that's the yuan, have allowed, everybody thought, well, the Chinese currency's got to get stronger. It did, and then the Chinese exports seemed too expensive, and we were buying things from Malaysia and so forth, and they have manipulated their currency to devalue it by 3% over the last year. So it's a race to the bottom in currencies. Is every country deciding it will print money, devalue currency to make its exports cheaper against the dollar, and to get their domestic economies growing again. And that's why the dollar looks so strong. But just remember the lesson of monopoly. Because I proved that to you, right? I mean, that's it. That was 101. You print more money, and what do you get? You get inflation. And inflation really destroys your plan very silently. Any plan you make, a business plan, a personal finance plan, retirement plan. I'm going to give a quick graphic example of that from my personal finance speech, because first of all, we really don't have much inflation now. It's not a problem yet. Okay, this is not a forecast of doom and gloom impending in the next 6 months, but the fact is, the Fed has an inflation target of 2%. They're going to get it, because every single central bank has decided that they've faced austerity, they have faced unemployment, they have faced unrest when they tried to tighten up, and now they're going to print. So, what happens to inflation? You better prepare for it. Here's a graph. Our inflation's average, it's meaningless, but if our inflation's average 3% on average, we've had some up years, but we've had some down years too, deflationary years. But it means that if you remember the 1960s when you could buy a good used car for $500, today to buy that same, and there aren't that many good used cars because of cash for clunker, it'd be about $3,000. And if we only have 3% inflation for the next 25 years, and if you're retiring next year, and you figure that $3,000 a month will do it for your expenses on top of Social Security, which is inflation indexed. So you'd have maybe $2,000 Social Security, $3,000 a month, maybe a little low because I'm out in Oak Brook and Oak Brook Terrace, but if you figured, okay, that'll do it, in order to match the buying power of that $3,000 that you think is very nice right now, you will need double that, or close to $6,000 in 25 years. That really impacts your financial planning, even a little bit of inflation. But we've had a lot of money printing. So, how do you hedge your dollar bet? We've already said that the rest of the world's currencies are not, at this point anyway, a very good hedge. The obvious hedge that everybody always talks about is gold, whether you do it through gold stocks or gold bullion coins. And by the way, commercial for Millennium Trust, if you have an IRA, I mean, gold is $1,260 an ounce. Do not look out if you're saying, Terry Savage said gold is going to double. That's not what I'm saying. I'm saying you need a small portion of your dollars hedged against the potential of inflation. Historically, gold has been one of the things that has done that. It's $1,260 an ounce today, down from $1,900 at its peak, but up from 20 years ago at $300 an ounce. And remember, you have announced the world's governments are all going to print, and the U.S. government, you think they're going to withstand another recession, or they're going to print again too? So, gold, commodities typically, and as you know, you trade futures in your properly constructed Millennium Trust custodial IRA. I didn't put real estate in here because real estate brings up a lot of issues. And by the way, you can't just put your house or your brother-in-law's house in your IRA and charge him rent. It's a long, complicated thing, okay? But you can read the column. If you go to terrysavage.com, scroll back on my Huffington Post archives, you'll see it from March. And the other thing that has consistently beaten inflation, there has never been a 20-year period where the stock market has failed to beat inflation. In fact, write this down, there's never been a 20-year period where you've lost money in a diversified portfolio of large company American stocks with dividends reinvested, even adjusted for inflation. That's ifs and facts. So you take 29 to 49, 52 to 72, never been a 20-year period. Another reason why all this money is going into stocks. Now, you know me, I'm very happy talking about the bulls and bears, but I can't resist adding a word for the chickens, all right? I created the term chicken money a long time ago, and chicken money is basically money that you cannot afford to lose. And so it goes into stuff that's very safe. And by now, you know exactly what the problem with that is. Our Federal Reserve Bank, in an attempt to subsidize the government's ability to finance its debt and to try and force the economy into growth, which it hasn't really been able to do, has kept interest rates artificially low. Stop looking around for the manipulated markets on the New York Stock Exchange. There may be, you know, the fast traders and so forth may be doing some of that. The biggest manipulated market in the world is the biggest market in the world. It's the market for U.S. government treasury debt. And it is being, and has been for years now, artificially manipulated to keep rates low. So no wonder we have these distortions in the marketplace, and no wonder money is flowing in stocks. No wonder bankers can't make money on loans, because the Fed has put its foot down on interest rates, and no wonder seniors who save money are going, what do I do? I better go get something that yields more. And I want to remind you of the mantra of the chicken money investor. I'm not so concerned about the return on my money as I am about the return of my money. Never was it more important now than now to be disciplined about that with a portion of your money, depending on who you are and where you are in life. Because, whoops, let me go back. This is a chart of the 10-year Treasury. And this goes way, way back. And the 10-year Treasury peaked, this goes back to 1962, peaked at 15.8% yield. Who remembers that? Come on, somebody with, I don't have any gray hair, but you can see. Okay. Treasury bills, 10-year notes were over 15%. Today, they are down to 2.63%. This is artificially low. And if you lock your money up for 10 years at 2.5 to 2.75%, and inflation does come back, it brings with it higher rates, because what dummy would lend money at 2.5% if they thought inflation was running not at 3%, or the Fed lost control, and inflation starts running at 5 or 6 or 7%, and what's the value of your 10-year 2.5% Treasury note? Goes down. So that's the bond market. It's this volatility, I won't get into that, it's the stock market. The discipline is right here to do the most difficult thing. The most difficult thing is always eventually the correct thing. What is difficult to do right now? The most difficult thing to do is hold cash when you're losing money, net to inflation, taxes to interest, and maybe in your IRA you're not losing it. But I mean, if you're getting 1% maybe on a CD for 2 or 3 years, you know your net loser to inflation right now, which is, quote, officially about 1.6%. It's difficult to hold cash, but cash gives you flexibility. It's difficult right now to think about hedging against inflation. You know, I started this on TV on Channel 5 in 1979 in January. And the first thing I said on TV was, oh no, gold at $200. I had dinner with Jory Luloff last Saturday night. We were reminiscing about this. I said gold was $230-some. I said, oh, it's going much, much higher. And I don't think I was ever going to get a second date on the show, but they liked the way I looked. I was a cute, young girl and talked about money. It's always hard to do the thing that's most out of favor. It's time to look at the money numbers and think about the potential that inflation could have on your bonds, on your portfolio, and do a little bit of hedging. And it's important to stick with stocks despite all your concern about how high can it go, because stocks also are a hedge against inflation. So I'm going to show you the biggest silver lining this year is it's an election year. I had this slide in there. It said they've learned their lesson. You remember the last 2 elections, we had government shutdowns, we had budget fights. Those problems haven't gone away. They're not going to do anything. And last night, we proved how scared they will be going forward with Eric Cantor losing his seat or in the primary. The fact is, Congress is now more paralyzed and more polarized than ever. And the good news is they won't do anything. It's also the bad news, but it's really more good news. And it gives you some breathing room, at least for maybe the next 6 months to the election period. So I'll give you a short-term forecast, and that's an easy one to make, barring any, exogenous shock like a war or a terrorist attack or something. Stocks will probably keep going up. It's the direction of least resistance. There's plenty of money around. The rates will probably stay low because we're borrowing less a little bit, and because the world is coming here and willing to buy our debt. The jobs economy will continue to grow. The momentum is there. As long as you don't sing, be happy, you know that there's some people that are out of the job market. But for those of you who are looking or want to expand, this is the time. Inflation, the official numbers, will probably continue to remain low until someone looks around and pushes a button and says, oh my gosh, look at these numbers. It's stayed low while that's been happening for the last 5 years. I don't think it's changing in the next 6 months. And the economy has picked up a head of steam because that's what America does. It grows despite what happens in Washington. That's what's so great about America. So until the election, you have some breathing room. Take advantage of it. Enjoy this summer. Enjoy this fall. Enjoy it till they reorganize Congress next February. Enjoy it till we all figure out what they're going to do to us next. Look, keep looking for the silver lining, not the cloud. But keep an umbrella handy. And remember, don't bet against America. America will survive and prosper. And so will you if you save and invest. That is the savage truth. And you can find more of that at my website, terrysavage.com, and where you will get a sign up if you want to my free newsletter that I write whenever I probably will turn today's talk, and since I build up a bit of steam, into a newsletter. And you'll also get a link to my personal financial organizer. You can go to my website, terrysavage.com, or you can follow me. The website is terrysavage.com. You can follow me on Facebook, The Savage Truth. Everything gets posted there, Twitter, et cetera, et cetera. Thank you for having me. This is going to be a good 6 months. Enjoy this time. Nobody can forecast beyond that, but the die is cast for probably 6 to 9 months of better economic news. Enjoy it. Thank you. We have questions. I really prefer it when people shut them out.
We can do that too.
Do it that way? All right.
Yeah, we can do that too.
All right.
Terry, thank you very, very much. It's always enjoyable to hear you. The first question is pretty current and very interesting. Can you discuss the student loan debt crisis and potential similarities to the housing mortgage industry bubble that burst?
Yeah, you can go bankrupt and default on a mortgage, and you can never get rid of a student loan. It isn't dismissed in bankruptcy, and if you don't pay it off one day, presuming you get a Social Security check, they will deduct it from your Social Security. That's the way it works. Student loans are an abomination forced on unsuspecting families in America. There is now $1.1 trillion in student loans, and that is greater than the amount of credit card debt. And as I say, you can't go bankrupt and default on it. Now they are now trying to extend, I challenged a group of regional banks maybe 2 years ago, 3 years in the summer. You can consolidate federal student loans, but the rates, by the way, are artificially high, much, much higher than the government collects on Treasury bills, pays to borrow itself on Treasury bills. The student loan rates are much, much higher, and parental loans, plus loans, are like 6.8%. So I challenged a group of bankers to be the first ones to form a consortium and refinance student loan debt. And they said to me, yeah, but they gave up the money to people who weren't qualified. There was no income qualification or work or credit history required for student loans. Those are really bad loans. Okay, folks, that's your tax dollars at work. And we've destroyed a generation of Americans. The president came out Friday, I think it was, and extended the availability of income-based repayment plans. And if you pay on time for 10 years, or 20 in government service, or 20 years, otherwise you can have the balance of your loan forgiven. But this is a huge disaster, not only for the people involved, but for our American economy, for the housing market. Because how can you have a mortgage on your life from a student loan and a mortgage on your life for a home? So you have not dealt with this yet. But then all the bankers are saying, what does she want them to do? Just write off the student loans? I don't know. What do you think?
Great. It is predicted that China will pass the U.S. as the #1 economic leader within 10 years. Any concerns with that?
I think it's surpassing the U.S. this year by some measures. It's a huge country. It's at its infancy stage, and it's growing rapidly. I mean, if you're a student, remember I talked about the long perspective. If you're a student of history, believe it or not, there was a time when Portugal ruled the world. It had the biggest navy, and its currency was the global currency. There were all those years of Great Britain, or the British Empire, ruling the world. Countries that rule the world and are the most powerful typically have two things. In those days, and you might change it a little bit now, they had the world's useful currency, and the dollar still remains the reserve currency, number one. And number two, they had the biggest navies. I mean, this is throughout history. And what we're doing is we're destroying our defense capabilities, our navies. Maybe it's not what you need anymore as a navy. And we're destroying our currency eventually. So why would it not be a surprise to see China, whether we like it or not, overtake us not only in growth, but more importantly in global power. But don't bet against America.
What are your thoughts regarding small employers, 50 to 100 employees, providing medical insurance to their employees in light of the health care exchange and the impacts of the Affordable Care Act on the economy?
Okay, you're small employers. This is not a political question I'm asking you now. You have 9 months now of the Affordable Care Act. Is it rude to ask you how many of you who are small employers have decided it'd just be a lot easier to let the government do this and give your employees benefits? I know a lot of people who've gotten much cheaper, you know, who don't have a lot of income, who've gotten much cheaper health care policies from the government. What have you done? How many have said, let's let the government take care of it? Are you all continuing your private health care, your company plans? Yeah? Well, hallelujah, I'm in Oak Brook. Go on.
This is an interesting one. Status of foreign trade agreements. So NAFTA, bilateral, multilateral trade agreements, export trading companies. What are your comments on that?
Well, I'm in favor of free trade. Fair trade, but free trade. I know economies work best. We complain about other countries dumping here, but we keep artificially high tariffs to protect some American industry. Start with sugar. So I'm not sure that this administration has pursued a particular emphasis on trade, but I'm not sure that's the most important thing they've messed up on.
Your comments regarding the U.S. business tax structure versus Europe's lower rates.
Well, don't forget, you know, Art Laffer was a very dear friend of mine in the 1980s, and he gave me the catechism on taxes. I mean, do you work to pay taxes, or do you work to make an after-tax return? If you get me started on taxes, I'm going to offend some people, because I think Illinois is doing everything it possibly can to be wrong. So it includes business, so I'm going to wait right here. Even though you didn't open that door for me. I'm appalled at what continues to this very moment to go down in Springfield. 5, 6 years ago, I wrote a series in the Sun-Times. What happened to the Sun-Times? Oh, budget cuts, so I'm not there anymore, but you can see my weekly column around the country and at terrysavage.com. But one of the headline series I did about 5, 6 years ago was the coming budget wars in Illinois, and cops would stop me and say, you don't really think default on our parents, and teachers would say, it's a guarantee by the state. Look, the one thing that the state cannot do that the federal government can do is print money. They know that. So they either have to cut spending or raise taxes somewhere at the state level, and of course I live in the city of Chicago. The only way out of a situation like this is economic growth. And you don't get economic growth by raising taxes. This is Econ 101, not Politics 101. And I'm going to prove it to you. Do you know who the biggest tax cutter of the 20th century was? Come on, you remember American history. Second half of the 20th century. You remember the biggest tax cutter, everyone thinks it was Ronald Reagan. It was not. It was John F. Kennedy. Kennedy cut the top personal tax rate from 91% to 70%. He cut the corporate tax rate from 52% to 48%. He instituted the Kennedy round of tariff cuts, which is a tax on traded products, and he didn't live to see all of that. And we had what became Kennedy boom. And Kennedy said, he was the one to say, paradoxically, there's a quote I've engraved in my mind, paradoxically, the way to increase tax revenues is to reduce tax rates. And anybody who doesn't remember this, or Kennedy was a Democrat. Cutting taxes to create economic growth is not Democrat or Republican. It's smart. And in Illinois, we're doing the opposite of smart everywhere. And we're setting ourselves up for it. It boggles my mind. I'm enjoying my home in Florida.
Before the last question, does anybody have a question from the audience?
That you dying?
Yes, sir.
What about minimum wage?
Oh, I'm so glad you asked. While we're on the subject of things that don't make sense, look, I full well understand. In fact, I attended a lunch with the chairman of, where the chairman of Walmart spoke, the executive club in Chicago yesterday, day before, and he was forced into the position of saying, well, we understand and we support certain increases in the minimum wage. Look, here is what's happened that's so weird. I said there's only been one place where inflation has shown up. It's rising stock prices. Yes, everybody owns some stock in their 401k or IRA, but basically you're talking about us in this room who have benefited from the increase in wealth caused by rising stock prices because the economy is so distorted that, as I said, the bankers won't lend and the consumers won't borrow and the businesses won't expand because of the real distortions in Washington in monetary policy and in tax policy and in healthcare laws and trade laws and all of that. So what you get is a distortion where all the money went in the stock market. If you're one of those who's watching people buy cars because they feel better, they've still got their houses and their houses are going up in price where you got foreclosed out, and you're working at a minimum wage job, you really do feel like you're falling behind. And thus the demand to get us even. But if you studied Econ 101, you know that they're printing a lot of money, and maybe in the name of equality and fairness, which is never part of capitalism and free enterprise, maybe they should get a raise in the minimum wage. Because after all, they'll spend it. And what's that going to do? Wage inflation, price inflation? It's a vicious spiral, but we're at that precise moment on the circle where it seems logical to all the do-gooders in America that we should give extra money away instead of creating more jobs. Because when you raise the minimum wage, all of you, and we're here at McDonald's corporate headquarters, where I spent an awful lot of time when I was on the board of directors and met a lot of people who started out doing a minimum wage job, worked their way up to corporate officers and country heads and so forth because they got the first job experience because it wasn't too expensive to hire this young kid. So the emotional appeal of raising the minimum wage is understandable. The political calculations of why this would be good and buy votes is obvious, but the economics is lousy. That's the savage truth. I get it.
Any other question before I ask the, yes?
Yes.
Don't you feel the stock market is fully priced now, having moved from Dow 6,500 up
Is
to
the stock market fully priced, moving from Dow 6,700 to touching on 17,000? Every day the stock market is appropriately priced. I've been around for a long, long time. It is not up to me to tell the stock market when it is fully priced, nor am I any good at making judgments about that. I found out on the trading floor. Here's what I know. The market is always right. And there's another trading line. The market can stay wrong longer than you can stay long. So the fact of the matter is the market sets the prices. We can only look back at history. We can only be appropriately diversified and have some exposure to stocks which have, number one, a call on America's growing economy, and number two, a history of beating inflation. Two good reasons to own some stocks, no matter what stage of life. But diversify according to where you are. understand the bigger picture, not just the current charts that show this going up or that going down, but the perspective, and you'll do all right. I believe that, I do not believe that China's going to beat us into the ground. I do not believe that this political impasse in Washington will last forever. It'll last through this next Congress, and then maybe as Americans we'll wake up and take our country back. Both political parties take our country back, become the moderate American growth country that we always have been, and start talking to each other again. We end on that? One more?
One more. On July 15th, when the offshore tax on dollars invested offshore by companies and the very wealthy takes effect, what effect do you think this is going to have?
There's a video circulating around the country that the end of the world is nigh. Because FATCA, which is it's not, by the way, a tax. It's, first of all, a disclosure that if you have 4 bank accounts, that you have to give first of all, the foreign financial institutions have to disclose that they hold accounts for you, and you have to disclose, you always had to disclose that you had an account outside the country, but now you have to disclose your highest balance during the year. Look, I should end on this, I'll just annoy you. Go reread Atlas Shrugged, okay? The politics of envy is very popular. There have been countries, South Africa, for instance, where they put on currency controls. People wanted to get their money out. Right now, money's pouring into America, okay? But just remember this, and especially in an election season. If you borrow from Peter to pay Paul, you will have bought Paul's vote forever. Free enterprise capitalism guarantees equal opportunity. It does not guarantee equal results. We need to work on equal opportunity in this country. We need to do that in terms of education, in terms of discrimination, of all kinds of discrimination. We need to work on opportunity through policies that create economic growth and incentives to work and produce and create and do what we do best. But you're never going to get equal results. The best you can do is not cut up the pie into equal pieces, but grow the entire pie so there's more pie for everyone. It's our country. Pay attention. We've got an election. The Congress is going to have a big, important congressional election this year. Pay attention to who you vote for, who you don't, to the message you send. This is our America. And finally, it's time for us to take it back. That's a savage truth.
Thank you very much, Terry.